Election years hit every sector with instability and fluctuation, and the stock market is not spared. Investors are left on the edge, wondering how the election year will affect their stock portfolios. In today's video, we'll dive into the relationship between elections and stock performance by analyzing historical performance of the stock market during past elections and how the 2024 election has impacted the stock market so far to see how you can strategize your investments. So be sure to stick around to the very end. Before we dive in, show your appreciation by clicking the like button below, subscribe to the channel, and turn on notifications for more valuable content. Whether you're a seasoned investor or just getting started, understanding how elections can impact the stock market could help you make more informed decisions. Every 4 years brings a lot of uncertainty and speculation into the financial markets. The thing is, ranging from changes in policies, each administration, whether Republican or Democrat, comes with a unique agenda, affecting sectors like energy, technology, healthcare, finance, amongst others, in different ways. Priorities and even global relationships are at stake, each of which can significantly impact stocks. Investors react to anticipated changes in areas like taxation, inflation, and regulatory policies, which can make the market more volatile than usual. For investors, knowing how markets reacted to past elections offers valuable insight. It provides clues into which sectors may perform well or suffer during election cycles. Think of it as a way to navigate through the uncertainty with a bit more clarity. Knowing which sectors tend to perform well or poorly during elections gives you an edge, allowing you to make informed adjustments to your portfolio. And not just that, it helps you make better decisions whether you're holding, selling, or adding new stocks to your portfolio. To analyze the power of elections on stock performance, we look back at previous election years, and a pattern of increased market volatility emerges. Typically, the S&P 500 and other indices fluctuate more during election periods as investors weigh the potential outcomes. For example, a financial analyst highlights how election years tend to be uncertain where energy, healthcare, and technology sectors are particularly reactive, but can provide buying opportunities as certain stocks surge. Historically, there are several sectors known to perform well during election years. The energy sector often reacts to policy changes, especially as candidates outline their stance on renewable energy versus fossil fuels. Healthcare also tends to be sensitive to potential policy shifts, with investors closely watching proposed changes in regulations. Technology is another sector that usually gains traction, as this area often represents economic growth and innovation, appealing to investors regardless of election outcomes. Understanding how these sectors respond can help investors align their portfolios to maximize gains or minimize risks during these unique periods. It will interest you to know this. In election years, 4 major factors tend to influence stock performance. The first factor is manifestos and policy promises. Each candidate's platform can shift market sentiment significantly, as their agenda can tell voters and investors where they stand on critical issues. For instance, policies promoting clean energy could boost renewable energy stocks, while pledges for deregulation may drive up industries like finance and technology. If a candidate proposes increased funding for infrastructure, construction and material stocks might see a bump. Investors keep a close watch on manifestos to anticipate which sectors will benefit from new policies. Also, another major factor is inflation. And the reality is, inflation is always a concern in investing, and it tends to be a hot topic in election years. Candidates' plans to curb inflation or stimulate economic growth often impact sectors like consumer goods, real estate, and financials. High inflation generally weakens consumer purchasing power, impacting retail and discretionary spending stocks, while sectors like commodities may perform better as inflation hedges. Investors look for signs in each candidate's economic plan to determine how inflation might be managed in the coming years. Additionally, monetary policies, especially changes in interest rates set by the Federal Reserve, are instrumental in shaping election year stock performance. Lower interest rates often stimulate borrowing and spending and boost economic activity, which benefits sectors like housing, technology, and consumer goods, while higher rates can slow and create downward pressure on growth stocks but benefit financials like banks. Both candidates in an election often outline economic strategies that involve Federal Reserve policies, which in turn affect investor sentiment. Moreover, during the election, the Federal Reserve's possible course on rates is heavily analyzed, as a new administration may impact its policies. For example, if the new administration supports growth-focused policies, rates might be held low, stimulating spending and benefiting growth-oriented sectors. But then, taxation is another key factor here. Tax policies are another key factor to watch. When candidates propose changes in corporate tax rates, capital gains tax or income tax, this can have direct effects on the stock market and market performance. Lower corporate taxes generally lead to higher profits, which is good news for stock prices. Higher corporate taxes could lead to a slowdown in corporate investments, affecting stock performance. However, companies in sectors like technology, finance, and healthcare may pivot strategically based on the tax incentives or cuts proposed by each candidate. Many investors view tax policy as a predictor of market performance by adjusting their portfolios accordingly to either capture potential gains or shield themselves from anticipated losses. The 2024 election has already brought volatility. Seeing some early market reaction, investors are paying close attention to the candidates' stances on serious issues, with the market reflecting shifts in stakeholder expectations. Early signs indicate a renewed focus on clean energy and healthcare reforms, and economic growth, increased interest in renewable interest stocks due to the heightened focus on climate initiatives. As we all know, healthcare stocks are experiencing volatility as both candidates outline their plans for managing healthcare costs and expanding access, as both prioritize these areas in their campaigns. As we approach the election, sectors directly impacted by policy stances, such as energy, finance, and technology, are seeing heightened interest. Also, from every indication, the market will likely continue its volatile responding to current concerns about inflation and interest rates, with many expecting from the Federal Reserve to adapt depending on post-election policies being clarified and implemented. Should the elected administration favor policies that stimulate lower taxes and deregulation, sectors like housing, consumer goods, finance, and technology may experience growth. Alternatively, if there's a push toward tighter and increased monetary policy, regulation, or a focus on climate change, renewable energy and healthcare sectors could receive a boost and would support sectors such as financials and commodities. Looking further ahead, the 2024 election's impact on the market will continue to unfold as policies are rolled out. Investors are also preparing for potential changes in interest rates and inflation management. The Federal Reserve's stance on interest rates could change depending on the new administration's approach to tackling inflation. If inflation remains high, consumer stocks may suffer, while sectors like energy and precious metals could gain as hedges against inflation. Likewise, companies focusing on domestic manufacturing may be positively impacted, especially in areas like chip production and infrastructure. You'll be amazed to know that the term election cycle pattern or presidential cycle is a recurring trend that influences stock prices during U.S. presidential election years. And this pattern reveals that market fluctuations follow a predictable 4-year cycle, mirroring the presidential term. And we'll be going over how stocks perform in each of these years, one after the other. Year 1, or post-election year. In this year, it is quite clear that there's growth in the market, although it may be small. This is because new policies are put in place for the new government. In this case, there are not a lot of fluctuations since equilibrium has already been achieved with the election results. Year 2, or midterm year. It is most common, however, to be the midterm year that is the second most encounters with sharp drops as political battles begin to emerge, and often between the executive and the Congress tents. Perhaps resultant conflict insert policy vacuums. Due to the uncertainty created by policy changes, among other things, markets are prone to suffer. Year 3, or pre-election year. In many cases, this year has witnessed active stock prices as dominant political parties strive to create an active, favorable scenario ahead of the next election year. This has always been the best market year because the election year politicians tend to focus their efforts on growing the economy. Year 4, or election year. In this year, investors anticipate discomforting waves as debates become more topical and real. This is a reason the market is usually strong, although there are changes throughout this year primarily against campaign strategies. The upcoming 2024 US presidential election might significantly influence markets due to today's economy and the importance of US trade policies and foreign relations for markets. Now, here are salient factors every investor must note. First of all, while elections may seem like a significant factor in stock market performance, research suggests that their impact is actually minimal. In fact, experts agree that election years don't necessarily affect stock performance, with an impressive positive average return of 11.8% every election year. Looking back at history, from 1926 to 2024, only 4 years recorded a negative impact on the stock market, and these were due to global economic crises like the Great Depression, the dot-com bubble, and the Great Recession in 1932, 1940, 2000, and 2008. This data implies that elections themselves don't dictate market performance, but rather broader economic factors. Also, the introduction of trade deals or changes in tariffs may influence supply chains and have varying effects on specific industries. Businesses with operations, particularly in manufacturing, might face direct consequences due to shifts in US foreign policy. The decisions made by the United States regarding energy policy have an influence on oil prices. It's possible that a shift in policy towards energy production may result in fluctuations in the prices of oil and natural gas, which can have consequences for nations that depend on energy exports. So, what's the takeaway from all this? Election years certainly bring a movement in the stock market, influenced by policy promises and economic conditions of candidates. But it's actually the shifting investor sentiment and global economic factors that affect stock performance, bringing a unique set of challenges and opportunities in the stock market. By understanding the historical patterns, keeping an eye on key sectors, and analyzing the influences of policy shifts, you can make more strategic investment choices. The 2024 election is already showing signs of impacting the stock market, and knowing how to adjust your investments can make all the difference you need. Thank you for watching today's video. Remember to like, subscribe, hit the notification bell, and share if you found this video helpful.